But first, I want to lead with a topic I've been wanting to address here for several weeks, and that's called the yield curve. What is the yield curve? Why is it important? Of course, it has to do with interest rates, and it has to do with short-term interest rates versus long-term interest rates. Now, the Federal Reserve can influence short-term interest rates by its various policies, and it's been doing that since Trump got into office. It's been raising interest rates pretty aggressively, just did so again. The key rate that it raises is called the federal funds rate, and that federal funds rate becomes a benchmark for all the other short and medium-term interest rates in the U.S. In other words, the so-called prime rate, which is the rate banks loan to their best customers, mortgage rates, etc., personal rates, loan rates, so forth. So the federal funds rate is pretty important. And when it rises, of course, the cost of borrowing and investing goes up. And if it rises too fast or too high, it makes the cost of borrowing too expensive. So businesses don't invest. People don't buy cars because the interest rate's too high. They don't buy houses because the interest rate's too high. Student loans, etc. Okay, that's the half of the curve. In other words, if you plotted the short-term rate changes, you would get a line. Okay, and the line would be curvy. It wouldn't be a straight line. All right, so that's one curve, as they say. Well, what about long-term rates? What do we mean by long-term rates? Well, long-term rates are bond rates. Bonds, meaning treasury bonds, 30-year treasury bonds, 10-year treasury bond, which is kind of a benchmark for bonds. And then, of course, corporate bonds follow the treasury bonds. So 10 years and up in treasury bonds are another curve. So you have a short-term curve, which is usually measured with the Treasury 2-year note. You see, the Treasury, U.S. Treasury, raises money by issuing what's called bonds, 10 years and up or 7 years and up, by issuing notes, which are 2 years, and it even issues 30, 90 days Treasury bills, notes, and bonds. All right, so the yield curve, yield means the return on your interest, it's your interest rate. The yield curve is really two curves. It's the 2-year Treasury note versus the 10-year Treasury bond. Now, you can use other interest rates as well, but that's the typical one, the 2-year versus the 10-year. Now, when the short-term rates, the 2-year notes, rise faster than the 10-year bond rises, or maybe the 10-year bond may not rise at all, or even may decline the interest rate on that, while the short term is rising, what happens is the gap between these two curves narrows. We call that the flattening of the yield curve. The gap between them flattens, and the two curves come together. They may even invert. In other words, the long-term bond rate might even fall below the short-term note or interest rate. When that happens, we say the curve has inverted. When we say that the gap is just decreasing between them, we say the yield curve is flattening. Okay? Why is this important? Because when the gap has flattened between these two curves, or inverted, worse, we've always had a recession. 17 times in the last 60 years, whenever we've had an inversion or even a severe flattening, we've had a recession. It's the best predictor of recession. Okay, we'll explain why it's the best predictor of recession. But for now, just take it for fact that it is 17 times it hasn't failed to predict a recession. Well, when's the last time that the curve flattened and inverted? 2007, right before the big one. And it's moving fast towards a flattening again as short-term interest rates, the federal funds rate, is driving up the 2-year Treasury note, which is now 2.46 or something like that, rising. And the 30-year, excuse me, that's the 10-year bond rate, by the way, excuse me. The 10-year bond rate is 2.85, something like that. I don't know what it is today. Maybe it's, the gap is narrowing again. I don't know. I haven't looked at today, but the 2-year is 2.4 something, and the 10-year here we're looking at the 2 and the 10-year. We could look at the 2 and the 30-year, but typically it's the 2-year and the 10-year. 10-year being the representative benchmark for long-term rates, 2-year being a representative benchmark for short-term. Right? And the gap is 0.34. It's only 1/3 of 1% difference between the 2 and the 10-year, and it's closing. And all of a sudden, now, well, maybe not all of a sudden, but Wall Street's getting concerned about this because it's such a predictor. We hear all this hype about, the Trump tax cuts are really going to boost investment and in jobs in this country. Well, it's slowing down. We got a little psychological hit to the Trump tax cuts, a massive $5 trillion, as I've been saying on this show, for investors and businesses and the wealthy 1%, who are the investors. Massive $5 trillion. And as I said last week, they're cooking another tax cut of $1.5 trillion before the November election, this time for capital gains taxes. Another one coming. Well, back in 2016, when Trump was running for office, he was talking about a $10 trillion tax cut. $10 trillion he was talking about, which was on top of a $10 trillion tax cut for businesses and corporations, investors, which had already been given by George W. Bush and extended by Barack Obama. $10 trillion already. Trump was talking about, let's give them $10 trillion more. Well, he delivered $5 trillion here in January, and now they're talking about another $0.5 trillion. So he's well on his way to the $10 trillion he promised the rich folks and businesses. Okay, so that was supposed to give a big boost to investment, but investment got a little boost, and it's already slowing. Business investment is already slowing. It was the only thing that was really keeping up GDP. By the way, the last revisions of first quarter GDP came in as at 2%. Trump is saying it's going to be 3 to 4% every year for 10 years without a recession. Okay, and if that's not true, then we're going to get, and we are going to get, $1 trillion plus every year deficits and added to the U.S. national debt, which is 21 trillion, going to go to somewhere between 33, 34 trillion over the next decade. Well, how are we going to pay for that? Well, the Federal Reserve is going to raise money. It's going to sell bonds and notes and bills in order to pay and cover that deficit. That's why short-term rates are rising. Remember I said the Federal Reserve raises short-term rates, or has a big influence on it, and they've been raising the federal funds rate, which is driving up other short-term rates, including the 2-year Treasury note. It's the Federal Reserve who's driving up the short-term rates because it's got to pay for these trillion-dollar-plus deficits. Yeah. Well, Why does it drive up short-term rates? Because if it's got to raise that much money, it offers to pay higher interest rates to investors if they buy the Treasury notes and bonds. That's why interest rates go up. If the Fed has to sell more, it offers a higher interest rate to sell it, to induce investors. And that's why short-term rates go up. And as a benchmark, they drive up the other rates. It's the federal funds rate that's being driven by the Fed, you see. And that's the benchmark rate. That's going up, and it's bumping up the 2-year Treasury note and other short-term and intermediate-term notes and rates. And it all comes down to having to finance this tremendous debt. Next week, the Fed is going to auction more bills and notes and so forth worth $125 billion. They're going to raise $125 billion next week. And they do this periodically every 6 weeks or so. They got to come up with a lot of money. So they're raising their rates, and the short-term rate is rising. And if it's rising faster than the long-term rates, the 10 and 30-year bond rates, then the yield curve flattens. It narrows. All right, we've been talking about why the short-term rate goes up. Why does the long-term rate go up or not go up as fast, which is happening now? Because the Fed does not control long-term rates like it can short-term rates. Long-term rates are driven by market forces and general economic conditions and investors. And investors don't see the U.S. economy performing robustly, as Trump predicted, over the next several years. The markets, the investors, the capitalists think there's going to be 4% growth every year for 10 years. In fact, they think it's going to be quite less. And you know what? They're right. So the long-term rates don't get driven, and the short-term rates do get driven because of the debt financing, and the yield curve flattens. What the yield curve flattening suggests is that the real economy, right, is not as robust and well off longer term, intermediate term. And by that I mean over the next 1 to 3 years. It's not as robust. It's not going to grow. The capitalists, the investors don't believe Trump. And the Federal Reserve, the central bank, is caught in between. Trump creates this massive deficit and debt increase with his $5 trillion tax cuts and his $100 billion a year increase in the level of Pentagon spending that's going up. They put in $100 billion a year for 2 years, but they're going to go for another one. Yeah. Okay, so it's this defense spending running amok and tax cuts running even further amok that are causing this huge deficit and a run-up in the debt that has to be financed, and the Fed raises its rates in order to finance it. But investors don't think the economy can handle it, so long-term rates do not rise as fast, or sometimes don't rise at all as the economy gets weaker and weaker. And look at the 30-year bond rates. They just won't go much above 3. And that puts the 10-year rate, got to be less, hovering around 2.8 something, while the short-term rates keep rising. At some point, the short-term rates rising stifle investment to such an extent, and long-term expectations aren't for growth, that businesses say, uh-oh, recession coming, let's stop investing altogether. Or instead of investing to create jobs in the real economy, well, let's just keep diverting this $5 trillion windfall tax cut not into investing to expand the economy and create jobs. Let's put it where we can get at it real quick and make a little bit here and there. And let's put it in financial asset markets. Let's put it in stocks or derivatives, or send it offshore to stock markets, or speculate in foreign exchange currencies, or speculate in oil futures. You see, that's why oil's going up. Or other financial asset markets. Or let's take $2.5 trillion of it and let's put it in buying up our competitors, mergers and acquisitions. That's where a lot of the money's going as well. You see, this big windfall is not going where it's supposed to go, or they say it's going to go, but it is creating these huge deficits and this run-up in the debt that the Fed has to finance that's causing a flattening of the yield curve. Now, the Federal Reserve, as I pointed out in my book, Central Bankers at the End of Their Ropes, here, published late last year, uses the excuse that, we're raising our rates to check inflation. You see, we're targeting the consumer price index. Well, actually, it's the PCE, similar to the consumer price index. We're targeting the PCE index, the inflation index, personal consumption expenditures index, right? That's why we're raising rates. Bullshit. Has nothing to do with it. Never has. It's an excuse. They're raising rates to finance this debt. And besides, the inflation going up, yeah, it's going up, but it's mostly being driven by rising global oil prices, which are always an indicator of financial instability coming. People forget that the last time we had a $100 plus cost of crude oil barrel was in the spring of 2008. Yeah, right before the big crash, you see. Because, as I've said last week, oil is a financial security. It's not just an actual resource commodity. And what drives the price of oil is global speculators in the spot market and other short-term markets. They're the ones who drive oil up and down. And the price of oil rises with the rising interest rates that drive up the value of the dollar. The interest rates, the dollar, oil, all linked in the direction in which they move. Rates are going up, pressure on raising the dollar, pressure on raising the price of oil. So, Fed raising rates has nothing to do with inflation. Never has. But that's the way they sell. They sell that. Read my book here, which takes a big critique of that and other ideological notions about central banks. By the way, the Bank of Central Banks, called the Bank of International Settlements in Geneva, is warning repeatedly, rewarding that we got a big problem in our central banks. The U.S. is raising rates to finance its huge deficit, but the economies in Europe and Japan and elsewhere are so weak they can't raise their rates. They got to keep them low. They got to keep pumping all the free money into their corporations because they're not recovering. Well, we got a big gap growing between U.S. rates and the rest of the world rates. That has an effect on global currencies. It forces other currencies to decline in relationship to the dollar. Well, if those currencies decline and you're doing business in Argentina or someplace like that, right? And the value of that currency is declining, well, the value of all your profits and returns are being eaten up by currency fluctuations. So what are you going to do? You're going to get your money out of Argentina. You're going to send it to the U.S. Yeah. And that's what's happening. It's called capital flight, you see. That's why Argentina recently had to go to the IMF and borrow $50 billion because the money's flowing out. And it's not just Argentina. It's the same story elsewhere in Latin America and many places in Asia and Africa right now. So Trump is screwing up the global economy at the same time. I mean, don't even talk about his trade war. He's screwing it up with his deficits. You see, the global economy is all linked today. It's all one economy. You can't just look at the United States economy and its condition. You got to look at all the rest, and not just Europe and Japan and emerging markets, but China as well. As the dollar goes up, the yuan currency in China goes down. Well, if the yuan's going down, investors in China want to get their money out. Capital flight. Yep. And of course, that has all kind of ramifications for the Chinese economy. Well, why is the Chinese economy, stock market slowing again? Remember, they had a big crisis in 2015. Well, for the same reason. Money, taking money out, and they're moving it around somewhere, trying to get it out of the country. And the Chinese government's trying to put controls on it, but it's sort of a moving battle between regulators and investors in China. And on top of this, we got all this trade war, which is all about domestic politics in November 2018. As I've been saying, we'll see. Trump is going to close some of these deals before November and say, and lie, which he does all the time. Look what I did. Big deal. Well, it's going to be token stuff, but he's going to brag to his base, his America First nationalist base, who likes all this attack on foreigners, whether it's foreign capitalists or, poor workers coming up from Central America. It's the foreigners that are the problem. They're the problem, not me, not my policies, not the policies of Obama and Bush before. No, it's all these foreigners causing all our troubles, you see. Redirect it, whip up people, and manipulate them for yet another election so he can keep passing trillion-dollar tax cuts to himself and his friends. That's what it's all about. That's how it works. Okay. So to summarize on this yield curve topic, right, we're getting precariously close to a flattening and inversion of the yield curve, which always predicts a recession without mistakes 17 times in the last 60 years, and it will predict it again. Right? Getting close, only 0.34 of 1% difference between the 2-year and 10-year rates. Getting very flat. Okay. All right, so let's watch the yield curve coming up. Going to be very important, very important. And we'll see what Wall Street does. Because once the yield curve starts flattening, Wall Street, investors in other words, get very nervous and say, uh-oh, signals here. Let's pull our money and run. In other words, the yield curve induces them to do what the yield curve is saying they're going to do. It actually makes it happen, you see. It meaning, let's pull in our horns on investing and job creating, which